Hey, ever had payday come and go so fast it feels like you never even got paid? Your bills take it all. And just like that, you're back to square one with rent due, groceries to buy, and no money left. When you're out of options, payday loans seem like a quick fix. Fast cash, no credit check, money in your account today. But are they actually helping, or are they just another trap? Most people don't realize just how expensive payday loans really are. And what's worse, they're built to keep you in debt, not help you escape it. So, let's talk about what really happens when you take one, how these lenders make money off struggling people, and what better options might be out there, even when it feels like you have none. Now, payday loans, also called cash advances, are short-term loans meant for emergencies. You borrow a few $100s and pay it back with your next paycheck. No credit check, no long approval process, just a quick loan when you need it most. And that's exactly what makes them dangerous. The fees are insane. Most charge $15 to $20 for every 100 borrowed. That may not seem like much at first, but when you do the math, that's an interest rate of 300 for 100, sometimes even 500% per year. For comparison, credit cards average around 20%. And this is where it gets ugly. Say you borrow $500. In 2 weeks, you owe $600. But if you couldn't afford $500 today, you probably won't have $600 in 2 weeks. So, you extend the loan. Payday lenders let you roll it over for another 2 weeks, but you have to pay another $100 in fees. Now, you've paid $200 just to delay the inevitable. And this cycle keeps going. Borrowers who roll over payday loans end up paying hundreds, sometimes thousands, in fees before they ever touch the original loan balance. The truth is, payday lenders rely on people not being able to pay these loans back right away. Over 80% of borrowers can't repay their loan in full when it's due. That means most people end up stuck, rolling over the debt again and again. And if you stop paying, payday lenders don't just let it go. They'll pull money from your bank account, even if it overdraws you, hitting you with more fees from your bank. And if that doesn't work, they'll sell your debt to collectors who might start calling nonstop or even take you to court. Some states allow payday lenders to sue over just a few $100s, garnish wages, or put liens on property. So, what do you do if you're in a tight spot? Because let's be real, most people who take out payday loans aren't doing it for fun. They're doing it because they feel like they have no other choice. First, check if your employer offers paycheck advances. Some companies let employees borrow from their upcoming paycheck with no interest. There are also apps like Earnin or Dave that offer small cash advances with lower fees. If that's not an option, see if you can get a small loan from a credit union. They offer payday-style loans, but with much lower interest rates and longer repayment terms, so you're not stuck paying it all back at once. If you have a credit card, even a cash advance from that is usually cheaper than a payday loan. Yes, there's interest, but it won't be anywhere near 400% APR. And if you're already in the payday loan cycle, call the lender and negotiate. Many would rather settle for a lower amount than risk you defaulting completely. Some states even require lenders to offer extended repayment plans with no extra fees. The bottom line is, payday loans are one of the most expensive ways to borrow money. They might seem like an easy fix, but most people who take them end up paying way more than they borrowed, getting trapped in a cycle that's hard to escape. So, before you take one, ask yourself, is this really my only option? Because chances are, there's a better way.